Incremental cash flow asks one question: how much cash changes if a project or decision happens? Incremental means additional. In finance, it focuses only on cash flows caused by the specific decision. The basic formula is cash flow, with the project minus cash flow without the project. Relevant cash flows are the ones that change because of the decision, including revenue, costs, taxes, and working capital. Total cash flow shows the whole picture. Incremental cash flow isolates the difference a decision makes. If cash flow rises from 100,000 to 135,000, the incremental cash flow is 35,000. Past costs are usually sunk costs. The analysis focuses on future cash differences caused by the decision. Incremental cash flow helps compare decisions by separating new cash effects from the business as usual baseline.